You'll not realize you'll become poor in 5 years. You have to hold on to hard assets.
So what is your prediction for the market, 2030 prediction?
We are in that stage where there's going to be a big reset happening. If I speak to someone today and if they ask me what to do, I say, don't put your money in a debt fund, don't sit on any form of cash. And the reason is, you'd be surprised. One of the highest performing index in the world has been the Karachi Stock Exchange.
Pakistan Stock Exchange.
Pakistan Stock Exchange.
But how?
So how Buffett became actually rich, right? He had 100 rupees, but he took 10,000 rupees of the public from the insurance business and redeployed that in the markets. Today, if you go to LIC, you open up any scheme, I don't think the return on capital comes to anything more than 4-5%.
Wait. You're saying LIC takes our premiums and invests that in the stock market.
Absolutely.
In the last 1 year, the markets have given 3 to 4%, but your fund has done 22% return.
One of the reasons for that return is that one of our strategies was sitting on 40% on gold. When I speak to investors, I'm saying you don't need to become an active stock picker. You can actually make a lot of money without actively picking a stock.
But how? Hi Rishabh, welcome to the show.
Thanks, Sharan. Thanks for having me.
So Rishabh, when most people think of a money expert or fund manager, they're typically thinking of a 50-plus-year-old grey-haired man. Now you're here sitting with me today and you're 32 years old and you're managing 350 crore rupees. So what do you have to say to the general perception that money management or people managing hundreds and thousands of crores need to have a lot of experience in the market, but you're just here 2 years older to me and managing 300 plus crores? So what do you have to say to that?
I think Sharan, age is just a number. And now with what we are doing and what's happened, with tech and AI and stuff, right? If you look at data, you can get all that experience. So if you're looking at 20, 30, 40 years of data, you can actually live through the experience of other people. So I followed Charlie Munger, and he says that, he reads a lot of autobiographies of people who've, been successful or even who have failed, right? Who've gone through so many things. So you can actually live through people's lives, learn through their mistakes, and you don't need to repeat those same mistakes. So I think even with finance, the same thing, right? We as a fund, as a team also, we've been reading so many different fund managers and what they write. And I think that's how we've developed our experience over the last 10 years.
So you've been doing this for 10 years?
Yeah, we've been doing it. My career started about in 2014.
So from the age of 22, you've been managing money. And from the age of 22 to 32, today you're sitting on 350 crores of capital.
So 22, I didn't start managing money. 22 is when I actually, once I got done with college, that's when I actually started my career. I got a job as a research analyst. I think the first so I worked there for about 2.5 years. And my role on a day-to-day basis was analyzing businesses the traditional way. So I think a lot of my foundation was built out there. I was surrounded by people who actually made a lot of wealth doing this. So I think that job sort of shaped my thought process that, okay, fine, if you can sit long term, if you can understand the process, if you can have principles to invest by, you can make a lot of money. But the one challenge that I found while I was at my job was that there's a lot of subjectivity involved in the traditional method of investing, wherein you have to take a call on the CEO. So if you go down to a meeting, and obviously the CEO is going to be a charming personality, right?
Yeah.
So he can easily influence you. And how do you sort of, not get influenced, right? So I think there was that gap, and I thought that there was a little bit of gut and intuition involved yet in making that investing decision.
Right.
And, so that's when I decided that, I want to explore more, right? Is there a way, is there some short way to make money? Is there some way that, we can remove all the uncertainty, remove that role of luck, right? So that's when I started exploring, are there any other fund managers who've done this? And I came across this guy, his name is Ed Thorpe.
Ed Thorpe. Okay.
There was another fund manager called Jim Simmons.
Yes.
And, he's the guru of Quant, essentially.
Yeah.
Right? He's done like 60-70% per annum.
And in the last 30-40 years.
In the last, I think 25 years or so. He started his career at the age of 50. He was an architect, professor, and, he was just a curious guy. And he started his trading career at the age of 50, and he just passed away a couple of years ago.
Okay.
Yeah, and he did a large number. He did almost like $20-30 billion. Right. So he was amongst the top richest people. So someone doing it at that scale consistently, never had a down year. His worst year was like 20-30%.
Okay.
Right. So I was heavily
never had a down year.
Never had a down year.
And average 60% CAGR.
Average 60% CAGR.
Wow.
Right. So
this is all using quant methodologies.
Yeah, so this is all like different quant models looking at different data points to sort of find patterns right? So I think these guys had a very big influence on my thought process. I think more from an inspiration perspective, because none of them, actually mention what they exactly do. Because if you have a model like that, you don't want to disclose it, right?
Correct.
So, but I figured that it's possible, right? You could do well, maybe not 50-60%, but even if you could consistently do like a 20-30% per annum with some sort of repeatable pattern and no uncertainty.
Yeah.
So that's how I, got into quant finance.
Okay.
So 2016, I came across two more partners, Kavan and Karan. Three of us for almost 1.5 years. We learned, so the first prerequisite to quant finance is learning how to code. Right?
And you did commerce, so you
So
didn't.
I did a BCom, so I didn't have any sort of background knowledge on how to code, right? So I think 2016 is like when I actually started learning how to code. And now I can code in 3-4 different languages. But those 2 years sort of were the building block and the foundation. I think the idea was very clear that, okay, you know what, we want to learn how to code because we want to figure out how to make money using quant finance.
Okay.
It wasn't to make a web application or a trading app or a bot.
Yeah.
The idea was very clear, right?
And it was just the three of you in a office in Mumbai.
Yeah, so it was not an office. Actually, we rented a house.
Okay.
And we used to sort of wake up in the morning and go to that house. So we used to start pretty early, like 8:30. All of us used to be there.
And by then you guys had quit your jobs.
We had all quit our jobs, and I think until 2000, till 2000. So we went through almost in that 2-year span, we probably built like hundreds of different models, and some were good, some were overfitted, some just didn't make any sense. Helped us shape our thought process. Also read a lot of books around this, and we started hiring a couple of people to sort of help us build those models, get better. And we started making money then. And, so when we speak in society or like when we're speaking to our friends, people are like, what are you guys doing? Just sitting in a room and trading. And we weren't actually trading. We were actually like just trying to build models. So we were never, sitting in front of the screen or looking at a stock chart in any way. Right? That was not, we sort of understood that this doesn't make sense. Right? I don't think all our life I can sit in front of a stock chart and trade. We didn't want to become a trader. So the thought process was to build the model and then sort of, automate it and let it run on autopilot. So those 2 years sort of helped us, build the groundwork. We started hiring a few guys. So a lot of our relatives and close friends, said, okay, fine. Can we also deploy money with you guys? And that's where in, 2018, that journey started.
Okay. So in terms of how you guys do it, you guys are a PMS. You guys have taken a license from SEBI. You guys are a PMS license. And if anybody wants to invest money in your fund, they need to have minimum 50 lakhs to invest with you.
Absolutely.
Right? So now, can you tell me a little bit about your ranking? Right? Like, can you tell me a little bit about the numbers of your fund? Like, what returns have you guys given? And what is your ranking in the last 3 years as a fund manager?
Right. So I think, so last 5 years, we've done about 26-27% per annum in terms of CAGR. The last 1 year has been pretty good. I think we've done about 20-22% in a market where markets have been sort of flat.
Wait. So in the last 1 year, the markets have given 3-4%, but your fund has done 22% returns.
Yeah.
Okay.
So that's correct. I think one of the reasons for that return is that one of our strategies, which we call the all-weather strategy, was sitting on 40% on gold.
Achha.
Even as we speak today, Sharan, I think gold is hitting an all-time high. It's at 118,000.
Right.
And so 40% of that portfolio was gold, and it was a quantitative bet, right? It was.
Yeah, can you actually tell? Because right now everybody is saying, should have invested in gold only. Gold is, one of the favorite asset class for India. All these equity guys came and said SIP karo. But at the end of the day, gold has beaten all the markets. But now as a fund manager, you have that flexibility to invest across the board, right? You can invest in stocks, gold, bonds, and all of that. And now you told me that last year only you took the bet to put 40% of your fund in gold. And last year, nobody could have predicted this. But how did you guys predict?
So we weren't trying to make a prediction. The way we work, Sharan, is essentially we are looking at past data and patterns, right? So what kind of environment are we in today? And what, has this kind of an environment been there in the past, right? Essentially, if you look at the environment today, we're in a high tension environment, like very volatile environment, trade wars, tariffs, and a very similar environment has happened in the 1930s.
Okay.
And essentially in times like this, there's a lot of money printing that's going to happen. So if you look at 2020 to 2025, I think Nifty did like 20% in terms of CAGR.
Yeah.
And it did so well because of the kind of printing that the US did. So, when I speak to an investor, when we discuss internally, I always look at this one stat. So the Fed balance sheet was about $4 trillion back in 2020. And, after COVID hit, they started printing money. I think in maybe April, May, they started printing money. Within the next 1 odd year, they printed about $4 trillion. So they almost doubled their balance sheet, right? Inflation went to 9% that year. All that money that was printed actually came down to the markets.
Correct.
Essentially emerging markets, US, India, everywhere, right? And that was a driver of that return. Now,
how does it eventually come to India? The money which is printed by US,
right.
How does that come to India?
So essentially, if any central government is printing money, that money is going to the hands of the rich or to the banks, right? And banks want to lend out that money then. Right? Now, if money is available cheap and it's in, say you can get money at 0.5%, right? You'll pick it up right from the bank. Yeah, I'm getting money at 0.5%. I just need to pay 0.5%, right?
Right.
So in 2020, interest rates went to 0. So you could go to the bank and pick up money. And there was absolutely no interest rate in the US. So the government was saying that you need to, stimulate the economy right now because there's a big slump.
Right.
So all that money came in the hands of investors. And, what do investors do, right? Just figure out what's the best market to invest in. So whether it was US, India was doing extremely well. So that's how through FPIs and FIs, that money sort of landed in India also and even other markets which were doing well.
And that's how the money goes into the markets and the markets go up.
Yeah, that's how the money. So the markets are heavily driven by demand and supply also. Right. So one part is that earnings of businesses have to be good. But the second part is also that it's driven by, say, the central governments of different countries and how much money printing they do. That is actually a big, lever in
But why did they, for the layman, why did they print so much? Like, okay, COVID happened, everybody is stuck at home. Why did the US suddenly start printing so much money?
So essentially when COVID happened, there was no income, right? So companies are not paying salaries to people. So, if I say, I had a tech job or say I was working as a gardener, I'm not getting any salary in my hand. So essentially in the US, I think 2 or 3 times, the government actually transferred $1,600 to each individual.
All 30 crore people.
Yeah, so they actually transferred money into your bank account. There were some criteria as to, who gets that transfer. But essentially a large part of the population just got money for free.
That's what the US government did.
Yeah, I remember, a cousin of mine was studying out there and, he would never buy a $200 shoe. And he bought a $200 shoe. I said, why did you buy a $200 shoe? He's like, yeah, I got money for free. So why not?
Wow.
So that's how that, so there are guys who are spending it on things. And essentially that's what the government wanted. That take this money and go spend it so businesses do well. And, the GDP starts growing again.
That's their own flywheel.
Yeah, that's their own. So essentially,
why did the Indian government not do that? We didn't get any free money.
So we didn't get any free money, but the government was printing money. Even today, the government is constantly printing money.
You're talking about RBI.
RBI.
They are also printing money.
We are also constantly printing money. So we are in this era of what we call fiat currency. So essentially, all the money that's there today should have been backed by gold. Right? So if you go back like, say 100 years or 150 years, ideally, if you had to print 100 rupees, you would have to put gold worth 100 rupees.
Right.
Then in 1970, Nixon came in and he said that, you don't need to back, this printing of money by any gold.
I will give you my word.
I will
you
give
go
my
print.
word. Exactly.
And people don't understand this. People think if I have money, it's money. But if the government is printing a lot more money, the value of my money goes down.
Absolutely.
And that is what you figured out. You took that bet that 40% of my fund will be in gold.
Yeah.
Now, how is this printing of money connected to gold? Can you explain that in layman terms?
So essentially, to explain that in layman terms, right? Recently, Warren Buffett was asked this question, right? Who's winning in an economy like this, where there's so much volatility and there's printing? And he said, people like me. People like me, because we are capitalists, we are sitting on assets, right? Because what happens is when printing of money comes in, asset prices go up. So you look at, look at asset prices in India or any metro like Bombay, Delhi.
Price?
So if you look at, say, the value of a flat, it's gone almost 2 or 3x in the last 5 years.
Correct.
Right? The reason it has gone up is because there's, easy money in the hands of people today.
Correct.
So imagine, right, in the US, they were transferring $2,000 or $1,600. So all through the year, you got like $5,000-$6,000. So now you have money to spend. So money coming in so easily into people's bank accounts. So, you're willing to buy assets. So there are more people to buy that same product. So obviously the asset price will go up.
When you mean asset, you're only talking about real estate?
I'm talking about equities. I'm talking about gold. I'm talking about real estate.
Okay.
All these assets do extremely well.
Okay.
But when I look at, when there's extreme amount of money printing, I think hard assets end up doing extremely well.
What do you mean by hard assets?
Say like land and gold.
Things you can touch.
Things you can touch.
Okay.
Right? Hard assets do extremely well. So the call for gold essentially came from 2 things, right? One thing was that lot of money printing is going to come into the future. They've already started printing a lot of money. So that's why price of gold will go up. Even price of land should go up. The second thing was that gold is sort of driven by central banks. People are not now, how the dollar, we speak about the dollar, right? In our lifetime, we've only seen the dollar being the superpower.
Correct.
Right? I think people are sort of realizing that it's not going to be this now in the next 10 years. We're going to see a downfall. So no one wants to hold currency anymore.
So what you're saying is this will keep continuing, printing will keep continuing?
Printing will keep continuing, value of currency will be worthless.
But why can't the government, let's say the US government, why can't they just stop printing? Why they keep printing like this? Even the Indian government, why they keep printing? It's like, okay, fine. Now people have money. Why don't we stop printing? What is the answer for that?
So the reason is that if the economy is doing badly, essentially you need to stimulate it, right? The only way, they have only two things that the way they can stimulate or control the economy, either printing or interest rates. So you can keep reducing interest rates, but you can only take it down to zero. Right? You can't take it below zero.
Okay.
So if I take interest rates to zero, now you can, come to the bank and pick up money. But even after that, no one is picking up money. Essentially, the government is saying, I need to continue printing. Right? I need to transfer money to people. I need to give it for even cheaper. So, they are the only two sort of, tools in the toolbox for the central government. Printing of money and interest rates.
So, right now we are in 2025. According to you, what should be the ideal asset allocation for a retail investor today? Based on whatever the hell is happening with geopolitical issues, war, in US government printing. If you are a retail investor earning 1 lakh a month, how would you invest your money? What is that asset allocation you would follow?
So the first thing is, right, if you're looking at risk adjusted returns, if you want to reduce your risk on the entire portfolio, gold becomes a great addition. One of the reasons why 40% of our portfolio is also gold is if you look at the last 20 years of data, if you plot a chart. So if you look at Nifty 50, Nifty is given about 12% per annum, long-term returns, maybe 20 years. If you look at gold, is also given 11-12% per annum. If you put 50% of money in Nifty and 50% in gold, and you sort of merge that portfolio, you look at the risk-adjusted return. So only Nifty is 12%. There are years like 2020 and 2008 where we've lost 40%, 50% of your portfolio.
Yeah.
So that's the risk that you hold with equities. If you look at gold, it's done 11-12%. There have been bad years or, 2-3 bad years where you've lost about 30% of your portfolio. But when you combine these two, they sort of are uncorrelated or have very low correlation to each other. The risk on the portfolio drops dramatically. You can make 12%. But you will not see more than like say 18-20% drop in the portfolio.
Got it.
So essentially, if you would want to run a very safe portfolio today, and I think looking at where the US is, looking at the kind of money printing that's going to come in the next 4-5 years, the debt crisis that they're going to go through.
You're saying it's going to continue for 4-5 years, this crisis?
I think that, we are in that stage where there's going to be a big reset happening. And the US is very close to a debt crisis. So they are sitting on $37 trillion of debt. All of that needs to get, maybe 30 trillion or needs to get refinanced in the next 4-5 years. And it's looking like it's going to be very tough. So, you see all the activity that's happening around us, Sharan. The tariffs, this $100,000 that they're asking for an H-1B visa.
Yeah.
Indirectly, what I'm saying, we need money in our pockets.
Yeah.
Right?
They're trying to make money.
Yeah. And why is the government trying to make money?
Because they have a debt.
Exactly. Right. So that debt crisis is going to come and they're really desperate right now.
So you're saying based on this current macroeconomic conditions, a 50% equity and a 50% gold is what you suggest for a risk-averse investor.
Yeah. So I would say that, you have to just check for your risk appetite, right? How much are you willing to lose or how much drawdown are you willing to see? See, it's going to be temporary. But ideally, if you add gold to the portfolio, it could be 30, 40%, even 50%. Depending on your risk appetite, and you can actually play along with the numbers. It's pretty simple, right? So we are into quant finance, and what we generally do is that, okay, fine, based on the last 20, 30, maybe even 40 years of data, can I play around and see that what percentage of my portfolio should be gold and what should be equities?
You keep changing that.
Yeah. So essentially that, like, based on risk appetite, I would decide.
How frequently do you keep changing this?
So once a year, once in 2 years. It's not an everyday thing, right? Okay. So it's not a trading portfolio. It's a pretty stable portfolio.
And right now, what is your asset allocation of your fund?
So in our flagship all-weather strategy, 40% of the fund is gold and 60% is equities.
Okay.
And that equity is also expressed through ETFs.
Okay.
So it's a fairly simple portfolio, right? So that's the beauty about Quant, right? You don't need to do anything complex to beat the market. So for someone who's a layman or a retail investor also, I think you can be a good fund manager yourself. You don't need to give your money to anyone. You can do these simple things. Look at last 20-30 years of data, build a very simple portfolio and actually outperform.
But what do I look in the last 30-40 years of data, as a retail investor?
essentially with Quant Finance, what we're doing is that ideally you want to do, the first thing is, from a top-down approach, you want to see how much equities you have, how much gold you have in your portfolio. Once you decide that, okay, fine, say I want like a 60 equity, 40 gold, right? You want to come down to, okay, fine, what kind of businesses do I want to buy in my equity portfolio?
Okay.
Right? Now, I think the biggest challenge for most investors is which stock to buy.
Correct.
Right? So essentially you're answering 2-3 questions, what to buy, how much to buy, and when to buy it.
Correct.
Right? So to answer what to buy, you can have a quant approach. So there is this book, it's called The Little Book That Beats the Market.
Yeah.
And we sort of started with that. That was like one of the first quant books I read that actually gave me a formula. Essentially, when you're looking at a business from a first principle, you're thinking that you want to think that, capital allocation is something that, that the promoter should, that scale for capital allocation should be very good. Essentially, return on capital employed for a business should be very high. So in that book, what he says is that, if you run this formula wherein you rank businesses based on return on capital employed and based on a valuation filter, say price to earnings or EV by EBITDA, if you just give 50% weightage and you buy the top 30 businesses year after year, you'll see a very beautiful portfolio.
That's it. That's as simple as that.
Yeah. So, this is what the book suggests. We sort of amend it to, what kind of portfolio I want to build. But essentially, anyone sitting at home can do this, right? You can even just buy the top 30 businesses based on return on capital employed, right? And then you can have some filters to check whether the business is a fraud or, whether the promoter is selling or buying or holding. But ideally, you create a very objective framework. Once you create this objective framework, you buy the top 30 businesses and keep churning every year. You do a back test, right? Like, you actually create a simulation where had you done this from 2001 to now, I think it would have done like 25% per annum.
Really?
Yeah. So probably, you would have 30.
Why don't mutual fund managers do this if it is so simple?
I think the challenge with the mutual fund industry is the size, right? So as a PMS, we're managing a lot smaller, but I'm saying that if I'm managing 1 lakh crores or 1.5 lakh crores, I think volumes become a problem for mutual fund managers. So all you can do is you can buy the top, the top 50 businesses, which is essentially the Nifty 50. When I also explain quant investing, this concept, I sort of mentioned the Nifty 50 essentially is the quant model, right? What is the Nifty 50? Is the top 50 businesses based on market cap.
Correct.
Free float market cap, right? There is no fundamental data behind it that is this business good or is return on capital high. So the question comes that, okay, fine, something so silly as given 12%. Can we add some filters and say, let's not look at only market cap or volume. Let's look at, return on capital, promoter health, or like, how much is the promoter holding and working capital ratios, right? So if you put those things in and you just use common sense, essentially you can do a lot better than the Nifty. Right? The Nifty is a quant model, but a very silly quant model. You can do a lot better than Nifty.
That's interesting. Nifty 50 itself is a quant model. But I never thought
Absolutely.
of it that way. So you're saying that as a mutual fund manager, because I'm managing more than 10,000 crores or 1 lakh crore, I'm not able to do all of these quantitative model techniques because I'm dealing with a large number of volume. And because there are certain restrictions imposed on me by SEBI, I cannot do this kind of investing that you're talking about.
Absolutely.
But as a retail investor and also as a PMS fund manager like yourself, who is managing the sub 1,000 crore mark, you can do all of these things.
Yeah.
So that means there is a certain limit of how much money you can manage as a quant fund manager beyond which these strategies won't work.
Honestly, it's a good problem to have. And I think that, I've not thought of that problem, because maybe I've not reached there. But I think like up to a 2,000-3,000 crore mark, it could easily be managed. There are a lot of PMSs managing 2,000-3,000 crores and doing very well. But I think in the next 10 years, we'll get there. Our market will be a lot bigger. And, if we were having this conversation 10 years ago, I would say maybe, I don't think I can manage more than 300 crores. Right? 10 years down the line, when we speak again, probably the number will be, 30,000 crores.
So what is your prediction for the market, 2030 prediction? What do you think Nifty 50 will be at?
So it's going to definitely be a lot higher than what it is today. And I think why I say that, I think I say that for all hard assets, whether it's land, gold or equities. If I speak to someone today and if they ask me what to do, I say, whatever you do, just remain 100% invested. Don't put your money in an FD, in a debt fund. Don't sit on any form of cash. And the reason is that, the $28 trillion of debt needs to be refinanced in the next 4 years. If you look at 2020, they printed $4 trillion, inflation went to 9%. When inflation goes up, everyone understands that all asset prices go up, which is real estate, equities, gold.
Right.
If they end up printing about $15-20 trillion in the next 3 years, think about it, what will happen to asset prices, right? So, even though we are in a volatile environment and there is some amount of risk to investing today, I think the bigger risk is not investing, because whenever they start printing in full throttle,
The value of your currency goes down.
it's going to go down, right? So you have to hold on to hard assets. You'll not realize you'll become poor in 5 years. I think a lot of people realize that, right? Anyone who's not invested over the last 5 years have come to know, like purchasing power has gone down.
I mean, I also feel it. In last 5 years to now, the purchasing power has gone down significantly. I mean, the government reports of 5% inflation, but I feel my personal inflation is like 20%.
Absolutely.
Because of the, higher luxury kind of expenses that, people typically have in a city. I feel my expenses have increased by 20% every year. So it's ridiculous.
And I think it's going to be way more in the next 5 years, right? So that's something that, I'm speaking to anyone, even on a personal level, right? You want to remain 100% invested, whatever it is, whether it's gold, whether it's equities, whether it's, land. I would not say real estate in particular. Flats in Mumbai and Bangalore are very different.
Yeah.
But, if you get a chance to invest in land, then even that, right?
But yeah, I mean, real estate as a hard asset is a great investment. Like a lot of people think I'm anti-real estate. But I am all for real estate if you have 2 to 3 crores of money lying around, because that is when you can actually play real estate the right way, where you can buy land, buy commercial properties and all of that.
Yeah.
But if you're sitting on 50 lakhs, 1 crore, and if you buy a flat, then I don't think that's a good investment.
Yeah.
I mean, you can
absolutely. Yeah, I think it's very illiquid also, right? Like at that, when you're in that bracket, when you have 1 crore, 2 crores also to invest, right? Real estate is it's also very local, like, the Bangalore market can be very different from the Bombay real estate market, right?
Yeah.
Even within Bombay, the prices are very different, depending on the area. Getting in, getting out of a transaction also becomes hard. So it's not so straightforward real estate. I think equities is a lot more straightforward. That's why I prefer equities.
And then gold is also there, as a hard asset.
And gold is also there as a hard asset, right? So owning those assets, definitely next 5 years, you don't have another option.
So tell me this. I know as a quant fund manager, you can't reveal all your secrets. But I want to know some interesting insights that you've observed, because you are looking at the past data and trying to look at patterns. That's your job, right? And looking at building a quantitative model around it to predict the future based on the patterns of the past.
Absolutely. Right.
Now, you also mentioned that Nifty 50 is a more simplistic quant model, that I will blindly invest my company in the top 50 companies as per their market cap, which means as per their size, right? But you said that's very simplistic. There are other nuances that we can look at to build better quant models. So any interesting patterns or trends you've noticed that if this is happening, then this will happen? So anything that you can share? Any basics of quants?
I think what I mentioned is sort of available everywhere. The most important factor in picking a business is return on capital employed, right? So I think if you buy businesses which have a high return on capital employed.
Can you dumb it down for me? Like, I'm a 15-year-old person. What is return on capital employed as a business owner?
So, okay, 2 things I'm looking at: return on capital and scalability. Now, think about it this way. I can sell sandwiches. I'm a sandwich wala, and I set up a stall. I get say 10,000 rupees investment. I set up a stall. I can make, say, 2,000 or 3,000 rupees a month.
Okay.
Right. So that becomes like a 20% investment every month.
That is sales.
Right. I'm saying that's profit.
That's
right?
profit.
Just for simplicity's sake, I can do that. Right.
Okay.
Say every year I can make 25,000 rupees. Right. So I'm doubling my money, more than doubling my money every year.
Because I invested 10,000 rupees to set it up.
Absolutely. Right.
The return on capital employed for the whole year is 250%.
So if Sharan could make an investment in a business like this, you would be very happy, right? 250% is great.
Yeah.
But then there's a problem of scale. And you're going to go to this guy, say, I have 10 lakh rupees to invest. He'll say, sir, मैं 10 lakhs का क्या करूँगा? Right. So you say, no, can you make replicas and can you grow this business in a way that you can make that 200% on 10 lakh rupees? He'll say, sir, it's not possible. Right. So essentially, there's return on capital employed and then there is scalability. You want to back businesses which can grow at high return on capital, which can do, say, 30, 40, 50%, and they can do it at scale. Right. So maybe they're starting small today, but their business can grow.
So typically, what industries are able to do both of them seamlessly?
Essentially, the industries keep changing. For example, last 5 years, we saw solar, right? Or we saw AI. I don't think so, that industry is going to remain constant. One thing that remains constant across most industries is brand value. So if you look at the way Warren Buffett invests in, say, like a Coca-Cola, right? Essentially, what he's looking at is for brands, or say a Walmart, or, if you look at a brand like Nike, right? These guys, the business models keep changing, but brand value yet remains. So if you were to look at something constant, you want to invest in businesses that have brand value. because that brand sort of commands a premium. You get a lot of flexibility when you're a brand. But if you would say that, what is the next crazy industry, I think I don't have an answer for that right now. But the industry keeps changing every 4-5 years. So last 5 years, say solar, I think across the board, all solar have done very well. Now you got to catch those trends by looking at where the government is spending, how much money are they putting behind it. For example, defense did extremely well, right? Last 10 years, defense has done extremely well. So this keeps changing. But as an investor, ideally, Sharan, if you're running a model like, what we do, you don't need to know this, right? There's too much information available. All you have to do is rank the top 30 businesses and keep rebuilding this. So we were part of the, one of the winners in our portfolio. We did like a 7-8x on a stock. And I don't want to name the stock, but we did that 7-8x. It was from the solar industry. And I didn't have any knowledge of the solar. Right? Essentially, return on capital was high. It was showing great, quarter on quarter earnings growth. All other factors were in check. It became a part of my portfolio. So ideally, when I speak to investors, I'm saying you don't need to do a 10x in the market. You don't need to become an active stock picker. You can actually make a lot of money without actively picking a stock. You can create a basket of stocks, which is essentially what quant investing does for you.
But that is as simple as that. Is there anything else in this recipe? Like, fine, return on capital employed and scalability of the business. Any other interesting trends you've observed in the Indian market that if this is also there, then it's better for your investment?
Look at the earnings growth of those Nifty 50 businesses. So it sort of converges over time. What we are looking at is, can we predict earnings? At all points of time, I'm not trying to predict stock price in any way. I'm not opening up a chart to see where the price, where the price is going to move. I'm not trying to find some candlestick pattern. I am trying to look at fundamental data to see how will earnings grow from here. Is there any scope for earnings growth?
So how do you predict earnings? Because such a complicated question. Because earnings is dependent on so many factors in the P&L. One thing goes off in your prediction, everything goes off. So how do you actually predict earnings growth?
So essentially, to predict earnings growth, what we're looking at the past, right? So when we're looking at the past, we're looking at if a promoter has given, say, a 20% return on capital employed and has grown the business, say, in sales, and earnings has grown at, say, 15-18% per annum for the last 4-5 years, I think that says a lot about him. So for this, I can give an analogy. If you look at cricket, right? You look at one batsman's one innings, I don't think so you can judge how good or bad he is. Right? You want to look at hundreds of batsmen and you want to look at hundreds of innings, and from that you can come to know, okay, fine, what is good or bad. When I'm picking a stock personally, I don't want to pick someone like, say, a Rishabh Pant or a Yusuf Pathan. I want to pick, say, a Pujara, a Rahul Dravid or a Kohli, right? Like, these guys have consistent performance, because unlike sport, this game of investing can go on for your entire lifetime, right? For sport, you have 5 years, 10 years and your career's over. But essentially, if you had to bet your life on, one batsman, you would say Pujara or Dravid, right? You wouldn't bet your life on a Rishabh Pant, right? He'd probably do a reverse sweep and get you out. That's the same thing with investing, right? Essentially, when I'm picking a stock, I'm looking at the past.
So basically, one of the important things you look at is vintage, that the company needs to be at least these many years old in the system.
Yeah. So essentially, even 2-3 years, 4 years of good track record
is enough.
Yeah. So the company could be even 15-20 years old. But what happens is every company goes through cycles. So you look at some of the solar businesses, they've been existent since pre-2000s also.
Okay.
Right. But they got this push from the government, and, probably like 10-15 years ago, they were very early in the industry and the industry didn't get that tailwind. But in the last 3 years, we've been seeing a lot of earnings growth, right? So that's when you want to pick that business. You don't want to pick the business in 2000, right? You want to see where that tailwind is coming.
Got it.
And that tailwind automatically show up in the data, right? 2 years of good performance, it will show up on your model. So you don't need to actually figure out which industry to track.
Okay. So earnings growth is there. You observe that the promoter has done a good job. But any unique insights that you have that which are not seemingly obvious to the naked eye, that, oh, I never thought this would actually impact my stock price. Any such kind of weird pattern things that you've noticed in the stock market?
I think one thing that we've noticed is the age of the promoter. So we sort of, this data is not very freely available. We've been like trying to collect this. So it's also called alternate data. Trying to collect and note down the age of the promoter. Generally, if you want to make like, say a 50 bagger, a 30 bagger, a 20 bagger in a stock, you want to make a lot of money in the stock. I think age of the promoter is extremely important, especially in the mid and small cap space. The perfect age is between like, you want to catch them when they're young. Let's say like a 35, 40-year-old guy. So he's probably seen 10, 15 years of, good experience in the business, probably seen his failures. And then that's where his career takes off. And then from 40 to 60 is probably his peak, right? And you want to hold him out then. So you want to buy small businesses. When you're looking at small businesses, promoters really matter.
Yeah.
And that sort of, we've seen that those stats that between the age of 40 to 60, making that say 5 or 10x, the probability of making that is a lot higher.
Achha.
Right? So that age of the promoter. But, you want to back this by data. You can't have one or two examples, because a lot of people say, "Arey, ye to 65 tha, uska bhi promote, stock 10x ho gaya." So there are, the entire world of quant works on stats, right?
Correct.
You want to sift out the role of luck, right? So the thing with investing is, right, Sharan, the role of luck is very large. As a quant manager, what I want to do is reduce that role of luck as much as I can. Right? Can I, at least attribute 80% of, management on skill? Right? So essentially, that's what we're trying to do. Trying to get the probability in our favor, get the odds in our favor.
Got it. So you're saying that the age of a promoter, if they are from the age of 40 to 60, is where they have already made a lot of mistakes, and now they're like really, really focused on the business, and they can really give you like a 20 bag or 30 bagger kind of a return.
Exactly, right?
I know you built this quant model, and you said it took you years to make this. Is it that if you reveal all your secrets, then it won't work anymore? Is that?
No, absolutely not. I think we also go through drawdowns, we also go through bad years. I think the differentiation comes that our process remains the same. I think the models are really simple. Even if you run that simple model of an ROC plus maybe a EV by EBITDA, I think you will probably beat most fund managers out there. So I think anyone can do this.
So if it is so simple, then why do people go to you? What is that additional thing that you do?
Essentially, what we do on our end is that we go back to first principles, try to understand that what are the best filters out there. How can we make the model better?
So you keep making the model better and better
at all points of time, right? And we also sort of take decisions as to, okay, fine, it makes sense to do this now for an investor. Also try to understand from the investor what's his risk appetite like. See, honestly, Sharan, we don't really market our fund.
Yeah.
And even when we started, it was more like, anyone who's aligning in terms of thought process, right? So someone who likes structure, who doesn't like subjectivity, who wants to be really objective, who aligns with our thought process in terms of our investing principles, I think they just end up, coming to us and sticking with us. And so we aren't actually going out there and soliciting anyone, why don't you invest in my fund? And the idea is that, this is what we do and this is how we do it. I think I wake up every day, spend maybe 6-7 hours, the first half of the day or till evening just on research because I enjoy what I do. And I think I want to continue doing this for the rest of my life.
What does research look like for you? How do you research?
Essentially, research is a lot of reading, trying to figure out, how the world works, how different things affect the world.
Can you give some quick examples of how different things affect the world?
So, there's that concept, right, of the butterfly effect. And the butterfly effect says that a butterfly, flapping its wings in the Amazon can cause an earthquake in Japan.
Right.
That's how interrelated the entire world is, right? Until a few years ago, I didn't really understand money supply and how macroeconomics would affect Indian businesses, right? I was always of that assumption, this business over here, it's not going to be affected by a Fed policy in the US. But that demand and supply, the money flow trickles down, comes over here, how it sort of, changes, if FIs are buying or selling, how it changes the dynamics of, our country.
Like, can you give an example with respect to the war situation? Like, how is the war situation in, let's say, Israel and Gaza? How is that affecting the Indian markets?
So, with war, I think more than the Indian markets, I give this example a lot. If you open, say investing.com and you try to find what is one of the highest performing, index in the world, you'd be surprised. If you were to take a guess, right?
It would be defense, would be my guess.
It's not India, like across the world, right? Globally.
Okay.
I think one of the best performing indices has been the Karachi Stock Exchange.
The Pakistan Stock
The Pakistan Stock Exchange, right?
But how?
Exactly, right? So what happens? So if you look at Karachi, if you look at, even if you look at Turkey, so Pakistan and Turkey have been in a very high inflation environment because they've been in a state of war. Right? Because what happens in case of war is that the government ends up spending a lot on defense. And to spend that money, they need to print money because they don't have any income in the form of taxes, etc.
Yeah.
Right? So you keep printing, inflation goes really high. When inflation goes high, the price of goods go up. But who benefits when the price of goods go up, right? Corporations. So for example, today Hindustan Unilever is, say, if charging 10 rupees for a chocolate, if, the raw material price is going to go up, they'll probably charge 20 rupees and you and I will continue consuming that.
Right.
And the stock price will reflect that. So think about it, right? A country that's in such a bad shape essentially has a high performing index. So even if you were in Pakistan, you would not lose your purchasing power if you are invested in the index. And the same with, I think that if you look at the Turkish index in the last 10 years, the index has become a 10x.
Wow.
If you open up the chart and you see it's become a 10x, I think the same with the Karachi Stock Exchange. And that's also how gold works. So if you look at gold in INR terms and you look at gold in, say, dollar terms, the returns will be very different.
Why?
So if you look at gold in dollar terms, long term would be, say, 7%. If you look at INR terms, it's 11% because of the currency depreciation of 3-4%.
Okay.
If you look at it in, say, like a Pakistani rupiah, it would probably be like 30% per annum because their currency is depreciated at a much higher rate.
Wow.
So when you own gold, you actually, you have nothing to do with the rupee anymore. Right? When you have, so, look at a very simple example. You give me a few notes, I'll give you a gold bar. Now, you don't have anything to do with the rupee. You're holding an asset which you can sell anywhere in the world.
Right.
Which holds value. So it's a store of value for you. So these, these sort of things. So this is the research that we do on a day-to-day basis, like trying to figure out how things work,
connected.
how things are connected.
So, which is your favorite stock to invest right now? Like, which is that stock where you have put most amount of your money, if you can reveal that?
So I think that, it's not a stock, honestly. I think gold is a large part of our portfolio today. But if I were to tell someone again, would you want to, what would you do for the next 5 years if you had to build wealth? I think you have to be invested in gold and equities. There is no other.
That is a asset class.
Asset class, right?
If you were to tell me a sector and if you can name a few stocks.
Essentially, we don't do that, not because I can't disclose it, but essentially as a quant fund, I probably don't even know, which sectors in terms of division.
Yeah.
For me, it's the top 30 stocks and that keeps changing year after year.
Right.
I'm not.
So for this year.
So for, even for this year, right, ideally, it's not the first stock or the 30th stock that will do well. In fact, I'll give you an example. A friend of mine said, Rishabh, can you send me the stock list? And, I want to invest. I said, why don't you invest with the fund? It'll make a lot of sense because we'll manage the portfolio in a professional manner. He said, no, just can you help me out with the stock list? I'll do my own research. I said, fair enough. And then, we sort of did like this 20-25% per annum in a 3-year period. And, I spoke to my friend. I said, you must have done well, right? Because these stocks were well. He said, actually, I bought only 14 stocks. And those 14 stocks ended up giving me only 6% per annum.
Oh.
So the idea is that as a quant fund, it's about the whole, right? Even I would not be able to predict that, this will become a 10 bagger or this will become a 20 bagger.
Okay.
Right? It's very hard for you to predict something like that.
So your prediction is more as a group of stocks.
Exactly.
Rather than individual stocks.
Rather than individual stock.
So that's how your quant models work.
Exactly. So if you had to today start, I would say, you start with that group of stocks. Don't ask me that, because that's a question as a fund manager you get every day. Koi tip milega kya? Which stock is going to move from here so that I can take that bet.
Yeah.
But that's the mistake that most retail investors are making. You take the tip from me or, from someone else. And, you'll forget to call me when you need to exit. And you'll not even realize what is the kind of position size that you need. Right?
Got it.
So you need to look at portfolio construction as a whole.
And what is an overrated stock according to you in today's Indian market?
So I think one overrated sector, if you were to ask me, I think is real estate.
Okay.
So within real estate, what they do is the way the market values real estate is, they look at the cross development value, which is how much space, or how much development is going to happen by that company in the next 4-5 years. And they, sort of value it against the market cap of the company. So say, for example, a Lodha is at a 1,20,000 crore market cap.
Okay.
And his presentation, he'll say that we have, say, a GDV, a gross development value of, say, 2 lakh crores.
Okay.
Right now, that 2 lakh crores is very hard to predict what is the time frame and, when it's going to come. And so I think that sort of industry is pretty, overvalued for one reason, that the industry, when you make a real estate sale, a large part of the money goes to the government. And the builder doesn't make a lot of money.
Okay.
Right? So I think if you look at the valuations today,
Builder doesn't make a lot of money?
Builder doesn't end up making a lot of money because most of the money is taken away by the bank and by the government.
What are the margins the builder makes usually? I always thought they make a lot of money.
I think if you look at it as on one flat, it don't make sense. But if you look at it as a whole, if you look at the inventory that's left back, if you look at the interest cost, I think that it's a very bad business.
Okay.
From a builder perspective specifically today, because the government has really increased, especially in places like Bombay, government has, increased ready reckoner rates, stamp duty values, property tax. There are so many hidden costs for a builder and interest. If you, as a builder, you go to raise, money, you will not get money at less than 12-13% per annum. Right? So all those things become very hard for a builder to make 18-20%. The business sort of, you look at most of the real estate businesses that are listed, I don't think anyone has, on an aggregate, the return on capital must be 10-11%.
Okay.
And you don't want to be a holder of a business that's doing 10-11%. Right? You want to be a holder of a business that's doing 30% or 40% per annum.
On the return on the capital.
Return on capital employed, not on the stock price.
Yeah, I'll tell you one more thing that I've noticed. Probably I shouldn't tell this, but I'm going to say it. So I moved to Mumbai around 2 years back. And until then, I've never had somebody come and tell me, invest in this stock. It's a sure shot bet. But as soon as I've come to Mumbai, I meet a lot of entrepreneurs who comes and tells me, I know this company stock CEO. He has told me it's a sure shot bet. Invest in this. And it's not like a one-off or a two-off thing. It's happening a lot. And this is called insider trading, which is very, very bad in the United States. If it happens, you can go to jail. So is insider trading very common in India? Because I'm hearing a lot such kind of news coming to me, especially in Mumbai, which is the financial capital of India, where all the billionaires sit.
So I think, this question comes to my mind also a lot. And I'll tell you why the question comes, because when I look at data, right? So,
by the way, this is how most of my entrepreneur friends invest. They are not like this mutual fund, that PMS. They're like, I have a sure shot, 10 on 10 conviction, because the source is valid. Right. I'm putting and I've made money, guaranteed, invest. This is how it is.
So essentially, this is a question that comes to my mind. And why the question comes is, when I look at data, I generally see, and this data is public, right? Before good result, the stock is already up 10%, 20%.
Correct.
It cannot be a coincidence that the stock has moved before the result, and especially a good result. Right? That means that someone has some amount of information.
Right. It is.
So I think definitely there is, this is happening because the price is showing that, not because I know of someone or, maybe even you know of someone. There are a lot of random people who say they have information and they probably heard it from the Panwala. But I think if the price is moving, and
if it has happened before
it's happened before the result, that means that there is something. And I think SEBI does look into these kind of matters, and maybe 1 out of 50 people get caught, right? But I think there is in life you got to live by certain kind of principles, right? Essentially, I was recently my dad was selling an old house of his because he was in need of funds, and someone was he committed and he shook hands with someone, and that guy said, okay, we'll do the deal. And we said, okay, fine. After 5 days, we'll take the token. And, the next day, someone else came in and he said, I'll offer you 20 lakh rupees more. And my father just said no, right? And so I asked him, I said, he's offering you 20 lakhs more, you're not taking a token. He's saying, see, the thing is that you have to live by certain principles, and this is where you start from.
Yeah.
Essentially, you'll get a lot of opportunities as an investor also, that, someone told you that, oh, buy this stock because I know the promoter.
Yeah.
Ideally, can you do this for the rest of your life? Right? Because you'll get that money so quickly. And even if you make that money once, right? I don't think so you'll be able to digest that money in any way. I think ultimately, you have to understand, if you compound your money at 20-25%, you've done the math so many times, right?
Yeah.
Sharan? And it's going to be a large number. You just keep going to have conviction on, on that principle, right? This one stock is not going to change me or my lifetime, right? It's not going to change my net worth. I think if I can do this for 20-30 years, and I think that insider trading is not something that you can do for 20 years.
Yeah.
Right. So even if someone comes to you with something like that,
these guys are called market operators is the term. Like, they're the ones who have the eyes and ears with every, promoter and CEO. So they sort of get this information knowledge coming to them. But you're saying it's not sustainable to do it.
I think, even if people are doing it, and even if it is sustainable, ultimately you're answerable to someone way above you. At some point of time, even after you die, you'll have to be answerable.
Because at the end of the day, it's theft, right?
It's unethical, right? So essentially, if I'm making money through insider trading, someone else is losing money, right?
Yeah, it's theft.
Because I bought it and then he sold it because you were buying it, and sort of you made that money, correct? So ultimately, maybe if not today, you don't get got today, but at some point of time, you'll have to answer someone. And I think living by those ethics and, creating those boundaries are essential. And you have to be answerable to yourself today. Maybe you took the action and you made money off it and you're really happy. But I don't think so, that is something that you should be sticking by.
So you made a very interesting point that investing can never be a 10 on 10 sure shot bet. But now let's come to AI, right? Like, the whole world is saying that AI is the future, and we are seeing a disruption happening across industries. And you made a point about when the tech boom happened. It's not that a lot of companies became successful. There's 2-3 handful of companies became successful. So what is your expert opinion on which are the AI stocks that's going to boom? I mean, obviously the usual suspects are, Tesla, Nvidia, Meta, Google, and all of that. But how would you look at it? Because the way I look at it is that, okay, these companies already have an advantage. They're already so large. They're already disrupting the industry. Shouldn't they continue to win? Isn't it already a sure shot game that these guys are gonna win and become $5 trillion companies themselves? How would you look at it?
So essentially, Sharan, when I'm looking at AI today and AI stocks and how AI as a whole has sort of helped quant investing, I think it's made the research process a lot faster for us.
Yeah.
But if you look at it from a pure stock perspective, I think they're going at some crazy valuations. So essentially, to justify those valuations that we are running at today, the earnings number have to be crazy, right? And I don't think so anyone in the right mind is able to give that earnings number. So as an investor, right, if I were to follow even a subjective investor like a Buffett's principles, I would say that if I can't predict earnings, I'm not going to touch the stock. Because then there's no margin of safety, right? If you're entering at say like 100 times or 200 times or even a 300 times earnings, what's the margin of safety that you have, right? You don't know, because if you're wrong, if the industry changes, you could lose probably 70-80% of your wealth also. And we've seen that in the past with the tech boom. So this could be a disruptor. This will be a disruptor. The AI boom is going to be there, but and businesses are going to change because of this. We're seeing that today. But does that become a great investment? No, not always. You know, it might be you can find a very boring industry and you can make a lot of money because it's available at a cheap price.
So, but let me again maybe deep dive into Tesla. So Tesla is disrupting two things. One is the EV segment, which we know is a clear energy transition shift, government push as well, and the leader. Obviously, there is China, BYD also coming up, but obviously Tesla will have its own market share. And second is driverless vehicles, which is Uber's market, right? I'm going to disrupt, logistics, right, without human involvement. And one more thing, last thing is robotics. Like human labor completely disrupted. Like people working in factories no longer needed. People helping us with our household chores no longer needed. Like robots coming and doing everything. And Tesla seems to be the leader over there. If not the leader, maybe it will have a meaningful market share for itself. I'm just trying to understand how could someone else come and beat Tesla right now, because they're so far up in the game. I can't even think of a second place competitor for this. Maybe you can educate me by looking at the past, where there was a company which was a sure shot winner. Nobody could come and beat it, and then somebody just came and disrupted it.
I think that's happened, right? Like you look at, the BlackBerry, right, as a mobile phone. Essentially, everyone was on BBM, right? Like 2008 to maybe 8, 9, 10. During our college days, school days, I think everyone had a BlackBerry. I think the BlackBerry Messenger was so disruptive that time, right? No one was chatting as much. And you thought that, this is going to be the next big thing, right? But what happens is that I don't think so. There's a first mover advantage in these businesses. And in this business, it makes sense to be the second and the third mover, because the first guy comes, he spends all the money.
Interesting.
He builds all the technology. And then there's a smart guy who learns from this, copies this, and then, has one up on the game. He knows what mistakes to not make, right? And that's what happened with the BlackBerry, right? So essentially, I think Research in Motion was the company name, and I think it fell by like 80-90%.
Yeah.
And it's nowhere to be seen, right? So I think on the tech side, these things will constantly happen. If you look at Buffett, he invested in Apple very late in its game. He invested like in 2017.
Yeah.
And I think he entered at like a $30, and it was about 10% of his portfolio. And I think it's at 250 today.
Yeah.
But he didn't look at Apple as a tech business. He doesn't look at it like a pure tech business. He looks at it as a retail business. Tomorrow, Apple can sell anything and people will buy it. Right? Essentially, they're making you feel good.
The brand power.
It's the brand power. So,
but now he's cutting his position.
Yeah, he's been cutting his position. He's been moving to a lot of cash. I have this view that Buffett knows a lot more than what he says.
Of course.
And I think he makes it very simple for people at large. If you look at the way Buffett has made money, I think, he's taken a lot of leverage on his entire book, but he doesn't really disclose it. He's been doing things that people don't know.
Why would he take leverage? He's sitting on so much cash.
So if you look at the entire business model, right, how did Buffett become the richest person, say the top 3 today by doing like say 20-30% per annum for like 50-60 years? A lot of people have done very well. Like Jim Simmons has done 60% for 20 years.
Yeah.
Ideally, he should be richer. Essentially, the capital base that Buffett has is very large. So he bought this insurance business back, like 50-60 years ago.
Right.
And what happens with an insurance business, say like an LIC, is, we as the public, we go and, pay premiums. That premiums, remains in the bank, and that money needs to be repaid, say, at the end of my life.
Correct.
After 30-40 years.
So there's a free
Buffett
float.
has that free float, right? So what he essentially did is that he took all that free float and invested in the stock market.
But he can do that.
He can do that. So insurance, that's what LIC does, right? You look at, today you look at holdings of large businesses. Essentially, LIC holds 2, 3, 4%.
Wait. You're saying LIC takes our premiums and invests that in the stock market.
Absolutely.
And if I need that money, they have it ready.
Exactly, right? So that's the math that they do, right? So they run on probabilities again. Essentially, how many people die this year? What if there's a calamity? Then what will happen? And Buffett has also done this math. And he's actually said it openly, like, okay, if these calamities plus this earthquake plus this hurricane, all of these things happen in 1 year, maybe we'll not be good for the money.
So this is actuarial science, if I'm not wrong.
Exactly. This is actual science. So how Buffett became actually rich is through leverage, right? He had 100 rupees, but he took 10,000 rupees of the public from the insurance business and redeployed that in the markets, right? Because he had to pay back. So today, if you go to LIC, you open up any scheme, I don't think the return on capital comes to anything more than 4-5%, right? Over a 30-40 year period. But they put their money in the market and probably grow at 12%.
Right. So basically, we buy the money back plans for 4 to 5% post-tax IRR. They are investing that money in the stock market and making 20-30% returns.
So say they're making even 12%, right? So the alpha is 6-7%.
So this is the game.
This is the game, and that's how actually Buffett. So there are two aspects to it. One is stock picking skills, but to become that large and to become the richest guy, on this planet, essentially this was a form of leverage that he took. And so if you can get money for that long at almost zero interest rate, then you would deploy it in the market, right? Anyone else would. But to design this, to think of this, you have to be a genius. I think there's much more than just stock picking to him. And your question was he's sort of sold Apple. I think he understands where the US is. I think he is sitting on the highest amount of cash he's ever sat on. I think he's sitting on about 35-40% in the form of cash in his portfolio. I think 30%.
But he shouldn't do that, no? Because the currency is depreciating.
Yeah, so I think he's trying to time the market.
He's expecting a big crash.
Yeah. So when you sit on cash, you are unknowingly timing the market, right? That means that you're not investing.
But he's been doing that for a couple of years now, right?
He's been doing that and he constantly does that. What he says for the public at large, when he's talking to the public at large, listen, don't try to time the market, remain invested.
But he does it.
But he does time the market, but that's because he's an expert, right? He's saying, see, I do this for 13 hours a day. And I tell people, like, you want to become like Buffett, wake up at like 7 o'clock, reach office by 9 o'clock, spend 12 hours a day, don't do any buying, sell, don't do anything, right? Just read, and do that for 30-40 years of life, you'll become like that, right? I don't think so anyone can do that. Like that's why you get only one guy like him right, out there. So I think he understands this. He understands all these different nuances and he can take that decision also. I don't think you and I can just copy him. So, when you're taking advice from someone, you got to understand from what context they're coming and what they're trying to say, right?
So Rishabh, how do you look at what is enough, right? Because you're a fund manager, your entire job is to understand money, right? Your entire, money is something that human beings have invented. Now you have made an entire profession around making more money from money. That's what you do as a job. How do you look at how much is enough from a financial freedom point of view? How would you look at it? Do you even think about money like that, or you're like, more is more, more is good, more is good? How do you look at money? Is there end to the growth?
I think definitely at some point I was like, I want more and I want more. And, maybe I started, if I make 2 lakh rupees a month, that would be crazy, right? What if I do 2 lakhs, I can fund all my expenses and and back when I was say a lot younger, I could do so much, I could take holidays. And I think,
if I may ask, what is your personal net worth today?
I'd say I have another, out of the 100 crores, about 30-35 crores is my money, right?
So 30-35 crores is your money.
Yeah, essentially. That's been compounding and I think I wanted to snowball over time.
But do you feel 30-35 crore makes you financially secure, or you feel like, no, I need more?
No, 100%. I think it's I feel very financially secure. I think that if you're staying in a place like Bombay.
You're in South Bombay.
Right, yeah. So I stay in South Bombay. Essentially, if you're staying in a place like South Bombay, right? I think if you have a house, if you leave your house aside, luckily I already have a house. But if say for example you already have a house, if you had to live very luxuriously, you could spend anywhere between 1 to 1.5 crore rupees and live very luxuriously.
In a year.
In a year. So say you have a car, you have a driver, you take vacations, you go to Switzerland, you travel the world, you do whatever you want. I think 1.5 crore is more than enough.
10 lakhs a month kind of.
Right, 10 lakhs a month I think is more than enough for you to, live a luxurious lifestyle without worrying about it, right? And to make 10 lakhs a month, essentially 1.5 crore a year. Right. So if you want to spend 1.5 crore a year, I don't think you can make only 1.5 crore a year. You want to make at least 5-6 crores a year so that you're only spending 20% or 30%. Essentially, you want to reinvest everything so that number compounds. See, essentially for me, I think I look at it as a game. right? For me, like life is a game, and essentially investing also becomes a game. And after a point, for everyone, I don't think, whoever you are, whether you're Buffett, Munger, Ramdev, I think the number stops mattering,
Yeah.
right? Like, I don't think so. The number is, I think it's a game that, okay, fine, can I get better at this?
Huh.
Can I wake up and do better research? You got to realize that the money should not get to your head.
Hmm.
You don't want to spend based on how much you made.
Right.
You want to spend based on how much you need, right? So you could essentially have a very simple lifestyle, right? You don't need to stay in a place like South Bombay also.
Right.
You especially in this game of investing, it's just your intelligence that's required, right? You don't need to speak to 20 people around you. There are enough books and enough, work on the internet that can help you make good decisions. So ideally, I think 1.5 crores in Bombay is like you can live a very luxurious lifestyle. After which I think, whatever you're spending is essentially,
Yeah.
I don't think so it's adding as much value. But up to then, because Bombay is an expensive place, right? So most people end up, a professional making like 30, 40 lakhs or 50 lakh rupees ends up spending most of it if you're living in Bombay, like
Correct.
rent and other things. So idea is that first, you try to save as much to get to that corpus, right? Say you get to 10 crores, 12 crores, that number to get to. So, even Ramdev gets, says this, right? To get to the first crore is the hardest, right? Somehow you get to the first crore, then the compounding journey, once it kicks in, right? You'll not even realize the number will keep getting bigger and bigger and bigger. And the moment you have, say, like 5 crore, 6 crore rupees, and you're making 20-30% per annum, so that's 1.5 crore a year.
Yeah.
Right.
You're adding additional.
Yeah, you keep adding and you don't spend all of that. You get to a number after which you realize, okay, fine. Because see, if you're growing your money at 15-20%, inflation is growing at 7-8%, eventually your number is going to be a lot bigger, right? Your purchasing power is going to improve a lot more.
Right.
So you want to figure out how to grow your money. I think, I never looked at how can I cut down my expenses. I always looked at it that, how can I increase my income? That's also the same way I look at a stock. So, often ask this question, right? Like what is my regret?
Huh.
Say financial regret. So there are two kind of errors that happen in the market. There's errors of omission and then there's errors of commission.
Okay.
Errors of commission are, for example, I bought a stock. I shouldn't have bought it. I bought Zomato. I shouldn't have bought it. It's down 30%. Right? That's an error of commission. When I bought it and it fell 30%, so I lost 30% of whatever I invested. Error of omission is I should have bought the stock. I had all the knowledge, but I didn't buy it because I was scared. And it became a 10x. If you look at Buffett, he says my biggest mistakes are not the stocks that I lost money on. It's the stocks that I didn't buy. That my biggest mistake is I didn't buy Amazon early on. My biggest mistake is that I didn't buy Walmart. It was a $10 billion mistake. Those mistakes are too big. I think the same thing when you're looking at life, right? Like I think you got to look at how much money you can make because that's infinite. And you can make a lot of money. So you cut down your expenses, but how much will you cut down, right? You can only cut down to so much. So I think rather put your time and energy and figure out how can you make a lot more money.
So realistically speaking, today if you have 10 lakhs, it is possible in the next 20 years that 10 lakhs can become 100 crores if they generated 25% CAGR.
It can become 10 crores in 20 years.
Oh, 100x, right? Sorry.
100x.
If I have 10 lakhs can become 10 crores in 20 years. Assume you can grow it by 25% CAGR every year.
It's that simple. Just 26% CAGR. So your first, first 10 years is your 10 lakhs becomes a crore and then the next becomes 10 crores. And honestly, like I don't think you need to actively pick a stock to do that. You can do that using models. Idea is that to go through those 20 years, right? Can you actually be disciplined?
So what is your last question? What is your your favorite book for the audience watching here on how they can get started on this quant investing and build those kind of portfolios for themselves, which they can get on 25-26% CAGR?
So I think there are two books that I would look at. I think the first thing is that to get into quant investing, you need to be inspired. And for inspiration, you would look at, say, like maybe 3 books. For inspiration, you want to look at Ed Thorp and you want to look at Jim Simmons. So Ed Thorp has this book called Beat the Dealer. He also has a book around the markets also.
Okay.
And Jim Simmons, there's a book written on him called The Man Who Solved the Market.
Okay.
And I think when you read about these guys, you figure out like, how they came from a humble background, how they actually did this just because they were curious. They just, just wanted to know that how markets work and how they didn't play this game to become rich. They played this game because they wanted to beat the market.
Curiosity.
Yeah, out of curiosity. And if you really want to, take action, I think that little book that builds wealth, and there's a little book
that beats the market.
That beats the market, right? So that book essentially, gives you that formula that how you can, actually build wealth.
Oh, there is a formula only.
There's a formula. In fact, you can just, like take that formula down, run a few tests. You can make it on Excel. So that's how we did it. Back in the day, like when I didn't know how to code, so in 2016, the first thing I did, can I build this model on Excel? And I picked up ROC, EV by EBITDA, gave it a ranking, and actually saw, I was like, damn, this is giving like 25% per annum. And then obviously continued working on that. So I think it's a great starting point. So if you want to be successful, you have to build knowledge. And with that knowledge, conviction will come. Once you get that conviction, then you can go all in.
And then you can be rich.
Then you can be rich, exactly.
On that note, guys, thank you so much, Rishabh. I
Thank
think
you,
it was
Sharan.
a very, very insightful conversation into the incredible world of quant investing. Thank you so much. And any last words of advice for the audience?
I think, thanks, Sharan. I think, when I came to speak to you, I think the idea was that to tell people that, absolutely anyone can do this, right? You don't need to be an ace fund manager. You don't need to have any sort of insider information.
Yeah.
You can beat institutions by simple models. So I think, why don't you get your hands dirty and start? And starting early is probably the most important thing.
Absolutely.
Yeah. Thanks, Sharan.
Perfect, guys. On that note, I'll see you in the next one.